Hi everyone, welcome to the Real Estate Tax Tips channel with Cherry Chen. I am on a mission to become the Google Map for hardworking Canadians seeking financial freedom. Today's topic is how to protect yourself and understanding the HST implication when you're trying to flip a property or build a new home. Typically when you try to build a property or flip a property, you would do some renovation to the property, make it nice, and sell it for top dollars. During this process, sometimes you may buy a distressed property and renovate it from top to bottom. And a lot of real estate investors do not understand the tax implication, the HST tax implication on sales of a substantially renovated property. And today we're trying to explain in detail the tax implication of building a new home or substantially renovating a property. But before I get started, make sure you hit the subscribe button below so then you can be staying on top of the latest tax tip, or make sure that you hit the little notification below as well, so every time I release a new video, you will first get notified. I have spoken about this before. Renovating a property is different from starting afresh and building a new home from scratch. It is a confusing area of the Excise Tax Act, the Income Tax Act that governs the sales tax. The CRA published several interpretations on this particular topic. If you renovate a property or build a new home, you may have to charge HST on sale of the property. It goes back to the simple definition. A builder is responsible to charge HST on a newly constructed or a substantially renovated property. So what is a builder? Who's a builder? And what is a substantially renovated home? Well, to summarize, for the purpose of this video, you consider a builder if you build a brand new home, or if you substantially renovated a property, or if you have purchased a brand new home or substantially renovated property. Now, building a brand new home is simple and straightforward. You might have purchased a vacant lot or a big lot with an old house. You tear it down, build a brand new one on top. This way, you will have some sort of HST implication on the sale of the property. If you renovate a property, it is not as straightforward. It goes back to the definition of substantial renovation. And CRA consider a property as substantially renovated if 1, all or substantially all, 2, of the existing building, 3, is removed or replaced. Now, all or substantially all means that 90% or more of the existing building is removed or replaced. And if you gutted a house from top to bottom, you might be required to charge HST on sale of a property. It's never simple when it comes down to HST implication on a newly built home or a substantially renovated property. I've come up with a quick decision tree to help you decide the HST implication under each scenario. In front of you is the summary, a quick summary in terms of the tax implication you have once you determine that you are a new home builder or you have substantially renovated a home. Once you determine that you are a builder, did you build a new home or substantially renovated a home? Once you determine that, you conclude that you are a builder based on the definition that we provided before, then you are a builder for HST purpose. And if you are a builder for HST purpose, there are 3 different types of use that you would use your home afterwards. You may use your new home for primary residence. So you substantially renovated a house and use it as your primary residence. The tax implication is simple. You don't have to pay any HST to the government. You build your own new home, there's no additional HST implication. On the flip side, you might be able to qualify for a new housing rebate with proper documentation. So you may be able to qualify for a $24,000 housing rebate available from the government to you. $26,000 is only the Ontario portion. Typically, for houses that are built today, you would not be able to qualify for the federal portion, but you will be able to qualify for the provincial Ontario portion if you live in Ontario and your house is in Ontario. So you can qualify for that new housing rebate if you have proper documentation to prove that you have renovated the house for 90% area of more. That's substantially renovated home. If you tear the whole house down, it's easier to qualify for the new housing rebate. Now, second scenario is that if you would use it as a long-term rental, so you build a new home or substantially renovated a place and use it and immediately convert it as a long-term rental. You rent it out to people who are using it as their primary residence. And in that case, you would then have to have a HST on self-assessment. What it means is that you will be required to calculate HST on the fair market value. You're essentially building a brand new house, selling it from yourself, the builder you, to yourself, the landlord you. A builder is selling to landlord. I know it's the same person, but CRA look at it differently. They deem the builder you as one person and the landlord you as another person, and they want to charge HST on that deemed sale. And that deemed sale is what's the result of it is the HST on self-assessment, on the fair market value of your property. So you need to do a self-assessment. If your property is worth $1 million, you owe CRA $130,000. The fair market value $1 million, and you owe CRA $130,000. You can lower that amount by claiming the HST that you pay to contractors to substantially renovate the property to long-term rental, and you remit the delta to CRA. If you also rent it out and you have a 1-year lease, you would also be able to claim a new residential rental rebate with proper documentation. So these all come in together as your tax implication if you use it as a long-term rental. Now, the last scenario is that you flip it. You flip the property. After you substantially renovate the property or you build a new home, you decide to sell the property immediately after. And if you do that, and if the buyers are using it as their primary residence, what you would still have to do is that you have to charge HST on the sale. But the builders, so you are, in this case, being the builder, can claim the new housing rebate on behalf of the buyer. So the buyer would have to sign a declaration declaring that they're moving in and using the property as a primary residence, and assign that rebate to you as a seller to claim it on behalf of them. Now, if you sell the property and you sell it to someone else and that's not using it for the purpose as their primary residence, you still have to charge full HST on sale. The buyers can claim the new residential rental rebate if they qualify. So you have to charge the full HST on sale. And that basically summarizes the tax implication on renovating a property, substantially renovating a property, or building a new home. Now, I'm going to go through 5 common questions that I get from my clients in terms of HST on these scenarios. The first one, am I liable to pay for HST when I renovate a property and resell it afterwards? Well, the answer is it depends. If you purchase a house with the intention to flip and you have done substantial renovation as per the definition that we have discussed earlier, you're considered a builder. You are required to charge HST on sale of the property. Now, residential resale homes are generally HST exempt, hence the majority of the sale would state that sales price is inclusive of HST. If you're selling a residential resale home that you substantially renovated, most buyers would not be willing to pay HST, which is 13% extra. The seller generally includes the HST in the sale price. When you build a new home after tearing the old one down, you're required to pay HST to the CRA. More often than not, the sale price is also inclusive of HST. Second question, what if I simply renovate a portion of the house? Am I still required to charge HST? Is there any HST implication? Well, that depends. If the renovation is not substantial, you're not required to charge HST. For example, changing the front door design and any interior doors, that does not count as a substantial renovation. And so you won't be required to charge HST, and there is no HST implication. All or substantially all means 90% or more calculated based on any reasonable method and basis, such as floor space, floor and wall space together, and number of rooms. If you have substantially renovated a house, chances are that you will be required to charge HST, which can eat into your profit. Many investors use the term gutted the entire house to represent such renovation. Most renovators try to limit the amount of work required and do not meet the definition of substantial renovation. You're still encouraged to keep proper evidence though, these being the before and after pictures, videos of renovation, amount of square footage that you had renovated, including the wall space. This will come in handy if you ever get audited. Number 3, is the housing rebate available if I build or substantially renovate a house that I sell immediately at completion? The answer to that is yes. New residential housing rebates are available for the builders to claim when the buyer intends to move into the property, or if the builder move into the property themselves and use it as their primary residence. Then the buyer, if they sell it, then the buyer assigns the rights to the builder to apply for the rebate. If the sale price is over $450,000, no GST rebate is available. You would still be eligible to claim $24,000 of Ontario PST rebate back. Suppose the buyer is intending on renting the residential property out. As a builder, you don't have the right to claim the new residential rental rebate back. The buyer has to claim this rebate themselves after closing with a 1-year lease. In other words, you would have to charge the full HST 13% in Ontario on sale. What is the HST implication if I build a home for myself or my relatives' immediate family move into the property at completion? This can get real messy. If you're building a house in the normal course of business, meaning that you are regularly a builder to begin with, you're building a home in the normal course of your business, so you just build another home, or you're doing it in the adventure nature of trade. This means that you're really taking advantage of the Income Tax Act and building a house because you're thinking that you would be able to flip it for a quick profit. You are still required to do a self-assessment on the fair market value of the property, meaning that you have to pay HST on the fair market value of your house. This will be done at the time of the completion. Self-assessment of HST is calculated at fair market value of the property at the time of completion. It's complicated. Let's use a simple example here to explain. Let's say you own a piece of land that allows you to build 4 detached homes and you fully intend to sell them to third parties for a profit upon completion. You start construction, claim HST, pay on the acquisition of land and all materials purchased. Life circumstances change and you decide to move into one of the 4 homes. In this case, you're required to do a self-assessment on HST at the time the houses are substantially completed. Now, another example, same scenario as above, except that you always knew that you intended to move into one of these 4 houses. You paid the HST and did not claim it back on a quarter of the land acquired. You also did not claim any of the HST pay on the expenses incurred on your particular house, one of the 4th. So you move into the property and occupy the place as your primary residence. In this case, you do not need to pay HST on the fair market value of the property. If you claim input tax credit on the purchase of materials and land, self-supply rules kicks in. You need to pay HST at closing on your own property at fair market value. Under both examples, you may be able to qualify to claim the new residential rebate. The federal portion is a maximum of $6,300, but your fair market value of your property has to be under $450,000 to qualify. In Ontario, the provincial portion, the maximum amount is $24,000. You would have to file the appropriate form and also all kind of documentation, including the breakdown of expenses, all the receipts to support your claim. So make sure you keep all your documentation, and you may be eligible for an unexpected $24,000 new residential home rebate. What is the HST implication if I build or substantially renovated a house and rent it out? If you build or substantially renovate a house, rent it out for a couple of years, and sell it, self-assessment rule also applies to you. You're required to calculate your HST payable on the fair market value when the lease starts. However, when you sell the property, HST does not apply, as HST was already paid at the time the property was rented out to someone else as someone else's residence. HST impact in the construction industry can be quite complicated. Make sure you consult a professional to see if there is any tax planning possibility, so you don't lose the 13% out of your profit to CRA. Now that we've covered the HST implication on substantially renovated home or building a new home, you can see how complicated it is. So make sure that you speak to someone who understands your situation to provide you with the best advice. If you like this video, make sure you give us a thumbs up, and if you have any questions or if you've substantially renovated a property, make sure you leave a comment below so you can share your stories with me as well. If you ever get audited by CRA on this particular topic, leave it in the comment below. Until next time, see ya!